This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 374 was produced on May 4th, 2023. I'm Eric Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Whalen Global Advisors founder Chris Whalen returns as this week's feature interview guest. We'll discuss the formative banking crisis, what's driving it, and what comes next. We'll also touch on the outlooks for stocks and precious metals.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, May 3rd, 2023. The S&P 500 was up 0.8%, closing at 4107. We'll take a closer look at that chart and key technical levels to watch in the post-game segment. The US dollar index was down 0.2%, closing at 101.22, continuing to remain weak, trading along its 52-week lows. The June WTI crude oil contract was down 7.7%, closing at 68.60, but the drop has been relentless as we have seen a peak to trough drop of $20 since the mid-April highs. We'll take a look at that chart, and Eric will have the EIA inventory data in the post-game segment. Gold up 2.1% to 2,037. Gold this morning is testing its all-time high. We will discuss the chart in the after show. Copper down 0.3%, closing at 384, and uranium up 2.4%, closing at 53.35, breaking out to a new high for the calendar year. The U.S. 10-year Treasury yield down 11 basis points, closing at 334 points. The key news to watch on Friday, we have the release of the jobs numbers, and next week we get the CPI and PPI inflation numbers, the Bank of England's monetary policy report, and the University of Michigan's consumer sentiment numbers. This week's feature interview guest is Whalen Global Advisors founder Chris Whalen. Eric, why did we get Chris back on the show this week?
We wanted to get a guest with a strong background for the topic of a deep dive on the banking crisis. And Chris seemed to have both a perfect background and, frankly, we also realized how long it had been. It's 2017, 6 years ago, since we had him on last. So needless to say, it's overdue.
Eric's interview with Chris Whalen is coming up as Macro Voices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Whalen Global Advisors founder Chris Whalen. Chris, it's been, I think, 5 or 6 years since I last had you on the program, so needless to say, long time no talk. Let's get right into the grit of what's happening. We're speaking just after the FOMC statement on Wednesday afternoon. It was widely expected that they would hike 25 basis points, and that's what they did. Is there anything unexpected that happened this week that people need to understand?
No, the Fed is sticking to the original script. The narrative is about fighting inflation. They don't want to talk about banks at all. And also, there's a big chunk of investors out there, pension funds, everybody else, who were also suffering as a result of the price change that occurred when they raised interest rates. It's bond market 101, and we're learning it all over again. And it's like the 1980s. If I were to compare today with a past period, it's really very similar to what Paul Volcker did when he raised short-term benchmark rates, the government rates, way above the banking system, and left them all underwater. So we have a modern day version of that.
Let's take a step back from the FOMC action today and kind of look at the bigger picture of what's going on here, because frankly, I don't mind admitting that I don't fully understand it. Seems to me like if we set the Wayback Machine to the last FOMC meeting 6 weeks ago, the story there was Silicon Valley Bank had just failed. Previous to that, everybody was expecting maybe 3 more hikes this year. But then everybody who was anybody in finance, when that news broke, they said, okay, the Fed's never going to hike again. It wasn't going to happen at the last meeting. It wasn't going to happen at this meeting. It was totally done, except that they did hike at the last meeting, and they hiked again at this meeting. Now everybody is saying it's totally done. That's it. It's got to be. That's the way to interpret this is clearly they're done. And I'm sort of thinking, Chris, this is all the same people that said they were done last month that are saying it again. Is it really done, or is the Fed going to keep fighting inflation as long as there's inflation there?
I think in a sense it's done because I don't think any of the governors really believe you can take it much higher. A 6-point change in 18 months is a lot. And the U.S. economy, is slowing. That's the real sense I have talking to bankers. Because what have they all done since Silicon Valley Bank failed, right? They've all stepped back to raise cash. The easiest way for a bank to raise cash is to turn the lending down a little bit. And that's what they're all doing. So that in itself is going to slow the economy. And then the fact that, you're going to have Fed funds, the other benchmarks above 6. The effective rate for people that are doing business in the real economy is 7 or 8. That's pretty high for financing inventory and financing production. So that's going to slow the economy as well.
Chris, the other thing that is different or has changed is when we talked about this a month ago, the story was, look, Silicon Valley Bank, special case, special situation, but it's over now. Don't worry about banking crisis. It's all done. Nothing to worry about. Nothing to see here. Then yesterday, we had First Republic fail completely. Clearly, it's not done. So what's really going on? If we take the CNBC and Bloomberg presentation of don't worry, nothing to see here, it's all fine. What's the real story? Is there a banking crisis on the scale of 2008 in the making that's about to happen, or is this really ending?
Well, no, I would say it's a different kind of situation, which is that the Fed changed interest rates rather dramatically in response to, I think the institutional hurt of being caught wrong on inflation, and very publicly. They've also been in the midst of a debate among the economist profession in the monetary policy world, who, on the one hand, think a central bank should keep its size minimal and not be as aggressive as the Fed. The Fed provided what they call abundant reserves, which included buying $9 trillion worth of securities. And those purchases distorted the market very badly. So what's going on today is that you have some disclosure that's pretty ugly, especially going back to the third quarter for mark-to-market losses on securities, right? That's gotten better since because the bond market rallied. If you follow the 10-year Treasury, that's kind of your surrogate for the mark-to-market problem, and it's better now than it was in the third quarter last year. The issue, though, is cash flow, which is that there's $30 trillion worth of assets that were created during 2020-21 that have very low coupons. The average mortgage coupon in the U.S. today is 3, and the median of that, group of loans, $13 trillion, is well below 3. So what that means is that the economy has, assets that are 15, 20 points underwater today. If you tried to sell them, you'd take a big loss. And so banks and also insurance companies and pensions and everybody else have a problem, which is that the Fed, just like the 80s with Paul Volcker, has left them all underwater.
Let's talk a little bit more about the 80s and what lessons we learned there, because it seems to me like what we're headed into is all something we've been through before. We got to a generational low in interest rates back in 1982, and as we came out of that generational low, and all of a sudden, boy, everybody's mortgage goes up, and people suddenly find themselves not selling their house that they want to sell because the next house they want to buy would come with a much more expensive cost of financing. So it changes all these dynamics and behavioral factors. But it all happened once before in the early 80s. So what did the 80s teach us that maybe would give us some insight into what's coming?
Well, in the 80s, as you probably recall, it wasn't easy to get a mortgage. It would take well over a year. And, in those days, there wasn't much of a secondary market for mortgages. If you got a loan to buy a house, the bank would keep it. They weren't going to sell a mortgage. Today, you have a very complex secondary market for mortgages that in turn, either helps or hinders the economy. And for the last year, because the Fed raised rates so quickly, the whole mortgage market, the secondary market, as we call it, was scrambled. The pricing made no sense. People were losing money on every loan. And so now that's settled down a bit. But overall, I think, housing's going to be pretty quiet this year in general. And it's going to contribute to a slower economy overall. But when you look at the 80s, it was very different. The S&Ls, what was left of the savings and loans, were just decimated when Volcker raised rates. And the commercial banks at the time weren't even involved in real estate. Real estate was seen as too risky. They barely made loans on commercial properties. So things have changed a lot since then. The banks got involved at the end of the 90s. 90s were very quiet in the housing space after the crash and the S&L cleanup. So, it comes in long cycles, housing. Housing is a 10 or 15-year cycle generally. And I think what you're going to see now is eventually the Fed will drop rates. You'll have a little mini boom in housing, go for a year or two, and then we're going to probably have a significant correction. It'll take us back down the, 2020, 2019 prices. Because, housing prices today are still very strong. The bank numbers for defaults are very low.
Chris, as you say, I think it's likely that there will be a retreat of some kind by the end of the year. The Fed will eventually be backed into a corner and have to cut. Are we headed into maybe a dip that's going to be a funding opportunity dip? In other words, is this maybe what's coming up going to be your last chance to get a low-cost mortgage or low-cost financing for other loans?
No, I think what will happen is when the Fed relents and they do have to let rates go back down, you'll see mortgages eventually trace back down into the fives, the low fives, but probably not much more than that. And I think the composition of the market still will be predominantly for purchases as opposed to refinancing, because so much of the market today is below 3%. Think of what it would take to get short-term interest rates down so you could even think about offering those people a refinance. They're 4 points out of the money. So that body of owners of homes is going to stay in place. I think they're going to have a big incentive not to sell over time. And eventually, of course, they will sell. There's many reasons people have to make a change. But still, price-wise. And by the way, the FHA mortgages, you can assume them. So when somebody buys a house, a starter house, for example, they can actually convey the mortgage to the buyer. That's something that people haven't done for years, but they're going to figure it out. It's a big selling point.
I had the impression that most of the securitized mortgages were not assignable in that way. Am I missing something?
FHA are assignable.
Okay.
VA too, but not conventionals, not Fannie and Freddie.
How much of a percentage of the market are those assignable mortgages? Is it a significant enough?
20%.
Okay.
Yeah. Government market's about 20% of the 13 trillion. Banks own about a quarter of it on balance sheet, and then the rest is conventionals and private label. So, conventionals are almost 8 trillion now. So they're a big chunk of it.
Let's step back to the bigger question of outlook for inflation and for Fed policy. A lot of people think that we're headed back toward 2% inflation, that this whole inflation scare has been a result of the pandemic. My view is not that at all. I think we've got a new secular inflation trend, which we're probably going back down on inflation, but not back down to 2%. At least I don't think so. How do you see this? Are we headed toward back to 2%, or is that a distant memory at this point?
I think inflation is much higher than the statistics suggest, and I think most Americans would tell you that. Cost of living, healthcare, you name it, right? Housing. Housing has blown the inflation picture out of it, but they don't include it in the statistics. So, the Fed historically has doctored the view of inflation to suit the mandate. But I think in reality, they have to tolerate a fairly high level of inflation, in part because they are terrified of deflation. They're terrified of letting housing prices fall, for example. So, the system is now biased, I think, towards inflation.
So we've got more inflation than the official story states. Let's take that and kind of compare it to the question of where the banking system stands, because the story that we're officially being told, and of course this is a confidence game, so the officials have some incentive to butter the story for us a little bit, but we're told, look, don't worry about Silicon Valley Bank. It was a fluke. This whole First Republic Bank, surely it must not be related. I think most of the smart guys I'm listening to are all saying, yeah, it is all related. It's the beginning of a banking crisis, and if the Fed pushes any harder than they already have, it's going to blow up in their face. Seems like, if I'm interpreting today's statement correctly, we've kind of got a pause indication. They went ahead with their 25 basis points today, but they kind of hinted that that's probably it for a while. Is that really it for a while? And is this enough? If we pause here and don't do any more hikes after today's, is that going to be enough to allow the banking system to recover, or do we still have a big crisis risk in front of us?
Oh, no, you have a significant crisis risk. You can track the optical risk. In other words, the mark to market on bonds, both available for sale and held to maturity, basically tracking the 10-year. So if you think about really horrible back in Q3 of 2022, it was almost 4% on the 10-year. Look at where it is today now. It's not as bad. It's actually cut it in half. But the real issue is cash flow. These banks can't just sit there with these assets that are paying 2%. And the Fed, I think at some point, is going to have to extend itself and offer to finance these assets at par at the coupon rate. In other words, if I bring them a Ginnie Mae 2, they're going to charge me 2% to repo it instead of 6, right, which is the current market. And then, when they finally drop rates and these securities get close to par, they can say goodbye to the banks and unwind the trade. But other than doing that, which means give the banks their cash back, let them reinvest at 6 or 7%, then they can slowly dig themselves out of the hole. But right now, you want to avoid a sale. You don't want to force these banks to sell these securities and these loans because they're going to take a terrible hit. And what you see, you've got to remember, a bank is 15-to-1 leverage. $1 capital, $15 worth of assets. If you start losing money on those assets, you very quickly wipe out the bank. So that's the issue here. And the Fed created this problem. I think they didn't know, they didn't want to admit that when they did all that open market operations, when they bought all those bonds, they tied their own hands to it. Because the reality is, if I were running this, I would have raised Fed funds up to 3.5, maybe 4, and then left it there. And I would have had the New York banks sell bonds. And that's about it. Because the system can't take this. If we leave rates where they are, we'll have a problem. We will have more bank failures.
Now, it seems to me there's two sides of that, because in the immediate sense, I see exactly what you're saying, which is the Fed can't push rates any higher. The Fed is probably going to need to start cutting pretty soon in order to avoid a problem. But hang on, inflation, that's a real issue. If they cut and cut and cut because they have to in order to deal with some of the risks you're talking about, it seems to me that there's an inflation runaway risk as soon as they do that. Do we need to be worried about that, or is the inflation runaway risk coming under control now that these other things are breaking?
Well, it's interesting. Your question, I think, is very typical, which is that people are still thinking about this inflation, growth trade-off as though it was 20, 30 years ago. But I would tell you that inflation is now embedded in the system, both because of the debt markets and just in general, the expectations from the equity markets. They're the people who are saying, oh, look, the Fed has stopped. And next week, they're going to say, oh, Fed's going to pivot because they're pushing and pushing and pushing for a rate drop to help equity returns. But, I think most credit people look at this and say, well, we're got to pay for lunch now because they know that over the last few years, we've had a free run. When the Fed boosted asset prices, they made everything go away in terms of credit. So, in 21, you remember, you couldn't even lose money on a used car. You'd pay off the whole loan. So today, you still have home prices very strong. So there's no problem in residential mortgage, but in commercial, there is. You're going to have a lot of pain in commercial real estate. And banks have a good share of that. They usually are senior, but it still won't matter because the losses on these buildings are going to be significant. So be like the 1970s in Texas. No, really, it'll be a lot like oil restructuring because these are big physical assets. What do you do with them? In some cases, you got to knock them down and build something else. That's expensive. It's very hard to convert a commercial building to resi use. It's almost impossible. You just have to have different plumbing and services and everything else, and it just doesn't work.
Chris, as I understand the commercial real estate argument, it's basically in the wake of the pandemic and everything, a lot of people continuing to work from home. We don't need as much office space. Is that going to eventually solve itself by people just don't build as much office space? Or do we have a structural problem where there's just going to be, we've hit a peak demand in office space and it's going to keep going down because we're going to have more and more people over time working from home and so forth?
Well, my uneducated observation is that I think change was already baked into the pie to some degree because of technology and other changes, but COVID enabled people to actually change their behavior. In other words, they had an excuse not to go into the office and to work from home. And technology enabled this. If we had to do this 10 or 15 years before, it would have been much tougher to get this to work. But we had enough off-the-shelf tools that companies just sent everybody home. I mean, I'll give you an example. The world of housing finance, which is huge, it's millions of people, they sent everybody home and they never came back. So these companies are now getting rid of office space and parking lots and everything else they needed to support that model. And they're going to a decentralized model where people have a hotel kind of office arrangement they can go into if they need it. Some have to go into a main headquarters. But a lot of these companies have moved down south. They've gone to Texas, they've gone to Florida. And, there are some dramatic changes there. In fact, if you look at office and low rise kind of commercial buildings in Texas, Florida, that whole arc in the Southeast, it's still very strong with a lot of activity. So, it really depends where you are. Real estate's always about location, but more now than ever, I think.
Let's talk about translating some of the views that you've already shared into trading ideas. We've talked about what's likely going to happen with rates and inflation and so forth. Where are the trades today? What are we actually buying and selling?
Well, for my portfolio, which is what I talk about with the blog, I only own a couple of banks. I actually own Western Alliance because I know them very well. They were one of the best performing banks in the country in 2021 because the mortgage industry was so hot. It was an interesting wholesale bank. They bought a portfolio company from Apollo called AmeriHome, which is one of the biggest conventional lenders in the country, competes head to head with PennyMac. So, that's really the only bank common I own. Most of my other bank exposures and preferreds, because in 2020, I looked at what was going on with COVID and the money markets, and I said, nope, let's rotate out. So I have been buying some of my mortgage companies, ironically, which are no longer the topic of conversation when it comes to risk. We're talking about banks now. But I own some Guild, which is one of the better mortgage lenders in the country. very focused on purchase mortgages. And they're an interesting firm because they're really good at expense management. They understand how important it is in that industry to watch your expenses daily, weekly, monthly, and they do a good job. I've written recently about PennyMac and Mr. Cooper. I kind of like Mr. Cooper better because they're looking at their portfolio of servicing really as an investment. I think they feel, and I agree, that a lot of this stuff is not going to prepay anytime soon. So the duration of some of these assets could be 15, 16, 17 years, which is extraordinary. The same assets, if we had been talking a couple of years ago during COVID, would have had a duration of 3 years. So that's what the change in interest rates has done to things like mortgage servicing assets, which is good. People are making money on that side, right? But when you look at securities, they've gone down in price that much. And that's what makes banks right now so difficult to get into, because how do you do fair value of the bank if they have a significant loan portfolio? It's going to be very hard. So the Fed has injected a degree of price uncertainty into a market that frankly has a lot of liquidity. I laughed when people said there's no liquidity. I'm like, no, there's plenty of money. It's just that people are not sure about price. And I think, unfortunately, the Fed has injected a degree of volatility and uncertainty. And it's only when the markets settle down a bit are they going to come and fix this problem. We should have been able to sell all of these banks if we had had time, but there was no time. And that's the key takeaway, I think. We have to, when you're selecting assets, when you're thinking about asset allocation, you got to really say to yourself, how is this industry going to be affected by monetary policy over the next couple of years? It's going to be good or bad. Mortgage firms are bad right now because volumes are low, but that means they're cheap. So I kind of like to buy things when they're cheap.
You said earlier that there's still plenty of systemic risk of a credit crisis happening. But you also alluded that one of the biggest mistakes we make is we tend to try to fight the last war instead of the next one. What's likely to be different about this credit event if people are sort of thinking back to, oh boy, it's 2008 all over again? You're saying it's really not. What else is going to be different?
Yeah, I think, Chair Powell is a very smart guy and he understands the markets. He understands duration. He needs to take a page from Jesse Jones's book. Jesse Jones was the head of the Reconstruction Finance Corporation in the 1930s. He restructured all the banks that couldn't qualify for FDIC insurance after 1933. They had a bank holiday. Congress created the FDIC, and you had to come in and prove that you were able to open. Basically, if you couldn't qualify for FDIC insurance, they closed you and restructured you. So in those days, they did a lot of other things that helped buy time. And that's what Powell needs to do. He needs to give banks a way of financing these assets without forcing them into a sale, which will decapitalize them and it creates deflation. And, the Fed did this because they're fighting inflation. That's great. But they have to be cognizant of how they impact the market. It's just a matter of basic sensitivity. I love to use that word in this context. But, come on. Do you really want to tip over big banks? No, of course not. And he's responsible for banks anyway. We should always remember that. But monetary policy comes first at the Fed, and they are obsessively trying to recapture their credibility after having it damaged considerably by the inflation spike. Was it their fault? No, it was COVID, of course. And I think a lot of it is not due to monetary factors, to your point. So it's going to take a long time to fix this, and we should be willing to give the Fed that time instead of being in such a hurry. I think the Fed's actually being rushed by the equity crowd who's saying, oh, it's time to pivot. Yeah, and you understand why. These people make money on AUM. AUM is falling if you look at the industry. Why? Because stock prices are down. So no one likes to see that. But, we had a decade of extraordinary performance for a lot of these banks, including the ones that failed. And now we're in a tougher environment. The outliers are going to be under a lot of pressure as a result.
Well, the stock market is holding up awfully well if you consider how much, it's a credit event. The last big credit event was 2008. If people think back to that, you could freak out. The market's not freaking out.
No, the mainstream names in financials has not really moved. JP is at 1.5 times book. So, in that sense, no. The real better, stronger banks. American Express is, I think, 4.5 times book, which is low for them. They're a very productive bank, very high asset turns. So you can make that argument, but the ones with more vulnerability, perceived vulnerability, have definitely been punished. I mean, look at Schwab. Schwab was trading over 5 times book. Now it's only 3.5. I love the business. I think it's a great story, but it's going to get smaller. They didn't need that bank that big. It was like a sailboat with too many spinnakers, okay? And they were doing great. Their credit performance is superb. But still, the market punished them for getting so big. And in fact, they have been shrinking since the middle of last year. The bank got up to, bigger than U.S. Bancorp. Okay? It was the 6th largest bank in the country at one point. So, all of these businesses that absorb the float from the Fed's asset purchases are not going to see that liquidity leave. And it's a key thing for investors to understand. When a bond matures on the books of the Fed and the Treasury pays them, a bank deposit disappears because the Treasury has to go out and sell that bond immediately. They have to refinance it. So somebody goes out and buys that bond, and the banking system gets smaller. That's the mechanics of quantitative tightening.
Now, since the Silicon Valley Bank event, the price of gold and other precious metals have moved back to the level where we're flirting with all-time highs. Has that been a result of the banking crisis? If so, how should we interpret the message?
Yeah, I suppose when you start to make people worry if their deposits in their, bank are safe, that's a problem. That's why the way the Fed and the other agencies have handled this has not been optimal. I remember Sheila Bair during the crisis. She knew her main job was communications because during the crisis, the FDIC was the most important consumer agency in Washington, bar none. They were protecting people's money, and they did it flawlessly. But in this case, nobody had any time. So they had to patch this all together. And I still think the regulators are struggling with a market that's A, moving this quickly, and B, you didn't have investors willing to really step forward and bid for these assets. You kind of had a bid from PNC for First Republic, but ultimately JP Morgan was going to buy the bank because they had a commercial relationship with First Republic. They had been selling jumbo mortgages and they were helping finance them. There's a whole group of banks that are involved in this activity, a couple of big publicly traded REITs. So First Republic was a well-known issuer, and none of them wanted to see the bank fail, obviously. It would have been bad for the market. So, I think it was a surprise that investors weren't more willing to come and buy these assets, other banks. U.S. Bank, for example, passed. They could easily have bought it. But, FDIC is interesting. Even if you have a better bid from somebody else, they're most interested in having the depositors taken care of and putting it away. They don't want it back if they give you a yes, right? So if you buy that failed bank, they want you to take responsibility for it. And that's how you have confidence, ultimately, right?
Speaking of confidence, how do we know really where things stand right now? Because it seems to me that the incentive of all of these institutions is to hide any problems they may be having, to not fess up to them. How much more tolerance is there in the banking system for more pressure before things really fall apart? And how can we tell where that risk exists?
Well, you'll see it in stock prices. I mean, it's a shame, but the reality is PacWest is at 0.35 of book, and that's bad. I mean, it's been down there for a while, but there's nothing inherently wrong with this bank. It just happened to get picked on, and when stock prices fall like that, you force the commercial customers of the bank to reconsider whether they want to keep doing business with you. Okay. So stock prices end up being a terrible bellwether for these businesses because you're getting voted on every minute of every day the market's open, and it doesn't help. So the shorts have identified these banks and they're going to go after them one at a time. I think the Fed and the other agencies really need to reconsider their policy. And if they're not willing to step up and help banks with this problem, then we're going to have more failures.
Tell me about the scope of that risk of more failures. Is it in just the U.S. banking system? Is it international? Is it global? How big could this go?
It's global in a sense of anybody who owns dollar assets that was buying assets like central banks or big buyers of U.S. Treasury paper. They also love Ginnie Mae mortgage securities. So the buyers of that paper have a low-yielding asset that is deep underwater. Ginnie Mae 3s this morning were trading at like 89. So it's 10 points under. And you figure they probably paid 103 or 104 when they bought the bond, because remember, during 20 and 21, the Fed had their foot on short-term interest rates. People were making money hand over fist in the bond market because spreads were very wide and the profitability was extraordinary. Now it's the opposite. Now the profitability is non-existent, and investors and issuers too are having to try and navigate this market. So it's a very extreme fluctuation for a relatively short period of time. If you think of 2019 on forward to today, there's been a lot of change.
And what do you see ahead in terms of how you expect this situation to resolve itself?
Well, I think if the Fed doesn't get a little more creative in how they're dealing with this bank problem, then we're going to have more failures, and they're going to have to deal with the blowback from that. I don't think members of Congress are going to be very happy if they see more failures. And remember, the industry stands behind the FDIC, not the Treasury. The industry is first in line in terms of loss, and they will pay through higher assessments. So they're looking at $100 billion worth of losses so far on these three failures. And, there's going to be a lot of political pushback on that as well.
Chris, I can't thank you enough for a terrific interview, but before I let you go, I want to talk a little bit about Institutional Risk Analyst, which is the name of the blog that you write. Tell us a little bit about that, what our listeners can expect to find there, and there is a link in your Research Roundup email for our registered listeners to find that blog. Tell them what they can expect to find there, and also what services you offer to institutional investors.
Oh, thank you. The Institutional Risk Analyst is actually a fairly old publication. It goes back to my original bank analytics firm with the same name. So we have a free version, obviously, in the blog that covers the global capital markets. We also occasionally put up profiles of companies and banks. And then we have a paid premium service where we dig down a good bit deeper on individual companies. We cover banks, fintech, and mortgage firms, of course. And then we have a quarterly roundup of the industry that's very popular, where we look at credit and try and track some of the trends in the industry in terms of profitability and operating efficiency. So, our focus is the global capital markets. I don't really cover European banks that much. Occasionally, Deutsche or one of the others. We did follow Credit Suisse very carefully because of that firm's role here in the U.S. But we're credit geeks, and we have a lot of fun with it. We've built quite a reader base, so we appreciate you guys giving us this opportunity.
Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, was a great interview with Chris. Now joining us in the post-game segment is Nick Galarnik. Let's get to the chart deck. Listeners, you're going to find a download link to the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Chris's picture that says looking for the downloads. Eric, what a week in crude oil. Let's talk about this chart and how did the EIA inventory numbers come in?
EIA printed a drawdown of 1.3 million barrels on crude oil inventory, but that was really a 3.3 million barrel drawdown after you consider that they pilfered another 2 million barrels out of the Strategic Petroleum Reserve. Now, they're still drawing down the Strategic Petroleum Reserve and increasing the rate at which they're doing so, 2 million barrels this week versus 1 last week, at the very time that they promised us they were going to be refilling it. Surprise, surprise. Cushing, Oklahoma, building 541,000 barrels, gasoline building 1.7 million barrels, distillates drawing down 1.2 million barrels. U.S. production ticked back up to its plateau level of 12.3 million barrels. So far, we haven't seen any print higher than 12.3 post the COVID pandemic. Let's see if we can get there next week. Tape action. Well, prices were dropping on Wednesday before inventory and continued to drop after inventory. Then on Wednesday evening at the futures open at 6 p.m., we had what looked like just a monster stop clearing run. At least as of yet, I have not heard any fundamental news to justify why it happened. But there was a sell-off all the way to a 63 handle. I believe the low print was 63.68 on June WTI crude oil. What drove that down? I'm not sure. It was back up above $66 within minutes, so it does appear to have been some kind of stop clearing run. Is that going to be the final run, or will there be still lower lows on Thursday? That remains to be seen. The next major support below that would be at 59.40, 5940. That's the 100-month moving average. Seems like an unthinkably long way down, but boy, the move we had on Wednesday evening's futures open was an eye-opener. Maybe there's more to come. Maybe that's it. We'll see what happens.
Yeah, Eric, it was quite a surprise drop for me. I was really watching that support line around $72. I thought that there was every reason for it to offer at least a reactionary bounce. But in the last two trading sessions, just relentless selling, just blowing through all these key support lines. We clearly got a bounce off the previous low. It obviously poked just slightly below, hitting some stop losses down there. But what will be really interesting at this stage is whether crude oil can get back into the 70s. If we see that crude oil spends day after day here basically rolling over in what was previously a support line now acting as overhead resistance, we could end up still seeing crude oil stuck down in these bottom end ranges. I wasn't expecting this degree of weakness, but this is a lot of technical damage, and it's going to take weeks to repair this technically. I think oil bulls are going to need to have a more realistic expectation that this isn't going to really turn in the short term, and that we're going to have to see something develop in the latter part of the year. All right, let's move on to the S&P 500. Erica, what are you thinking here on these markets?
No real change from last week. I still think the bear market bottom is not in yet. I think it's a credit event that's got to take us to the new stock market low. And I think we're headed there probably by the end of the year, maybe into early 24, somewhere south of 3,000 on this S&P before this is really over. I won't be at all surprised if we first rally up to the 61.8% fib level, which is 43.09 on the S&P. If that happens, I'll short it there with a stop maybe 100 points or so above that and see what happens. But I don't think it's over yet.
All right, Nick, I want to get you into this conversation. On page 3, we have the S&P 500 support resistance levels. What levels are you watching, bud?
Yeah, Patrick. So spot right now on SPX is 4090 approximately. There's a call wall above at 4200, which has acted as significant resistance. There's a put wall below at 3,900. Interesting to note that it lowered from 4,000 down to that level. So now we're at 3,900 on SPX for the put wall. The expected move right now for the May 19th OPEX, which is 2 weeks away and change, is 110 points in either direction. So the upper expected move is right to that resistance area of 4,200. And the lower expected move is below the key area of support at 3980 approximately. So key resistance again right now is 4100 just above us, which we broke below yesterday post FOMC. Above that is 4150, and then that key area of resistance, 4200, which is also the expected move, upper move, for 2 weeks out. The key support areas are just below at 4050, and then 4000. If we break below 4000, chances are we end up pushing pretty hard and fast down to that put wall area of 3900 or so.
Nick, it was interesting that you were talking about that 4,000 level, because on page 4, I put that 200-day moving average, the ascending trend line, and even the Fibonacci retracement zone, which is not drawn on there, all converge around this 4,000 level. And the way I look at it, even though the market reacted on the FOMC with a little bit of weakness, and we still have the jobs numbers in front of us, what will be really interesting for me is, will the bulls be able to dig in and hold the support line? If it does, there's always that chance that we're going to have that one last push up to even potentially break above 4,200. But in order that scenario to happen, I think this support line you were just talking about does have to hold. And I don't think it's going to take more than a few trading sessions for us to find this out.
Yeah, I think if we hold this, 4,100 area and bounce back above it and push above 4,150, I think there's a good chance we see new highs. But again, tonight we have Apple reporting. That should be the main catalyst going forward. If Apple has a poor report, I expect the market to sell off and test that 4050 area and possibly the 4,000 area. And that could be the short-term catalyst to the downside. Obviously, in addition to the speculation that we have some more regional bank failures, perhaps.
All right, Nick, let's take a look at the QQQ and the support resistance levels there, because like you're saying, Apple is coming out. It's one of the last major big ones to report here. What are the levels on the Qs you're watching?
Yeah, so right now the spot price on Qs is around 317. We have a call wall above at 325 and a put wall just below at 310. The implied move for the May 19th OPEX is about 11 points. Upper expected move is 328. Lower expected move is 306. Key resistance right now is just above at 320, which we poked above for about a day or so, and key support is at 300. And again, like you mentioned with Apple, if they perform well, obviously we're probably going to see some upside in Qs. But if they don't perform well, we'll probably see some downside back to that 300 area or so. And thus far, we've noticed that, the mega caps like Microsoft, Amazon, Google, Meta, they've done pretty well overall, save for maybe Amazon pulling back after their initial pop off their earnings. If Apple does well as well, then we'll probably see some more upside. And again, the reason being is that looking at these companies, they're all individually kind of conglomerates now, tech conglomerates, if you will. And so they have such massive size in the market that, even, 4 or 5 of them doing well can carry the market higher, even if everything else does poorly. So I'm kind of short-term bullish cautiously, but longer-term bearish.
Right, Nick. So one of the interesting observations, S&P 500 is trading already back to the lows of last week. But what's interesting about the NASDAQ is that we're still on the NASDAQ 100, 200 to 300 points higher than last week's low. That just continues to show the relative strength that the NASDAQ is having. On page 6, I have the Russell 2000 futures, and what we can see with the small caps, they're trading at not only the year-to-date lows, but only a stone's throw away from the lows of last year. That weakness continues to be evident on the small caps. The breadth of the market continues to be incredibly narrow, and just exactly like you're saying, those mega cap tech names are just keeping not only the NASDAQ up, but also keeping the S&P 500 at more elevated levels relative to something like the small cap index, which is showing some very broad weakness. The one thing I wanted to also highlight, though, on page 7 is that regional banks ETF, the KRE, and just continues to show how very weak regional banks are. And this is a huge drag on the small caps, as many of these regional banks are in the small cap index. And that's something Chris Whalen was talking about as well, that we continue to see that this is where the weakness continues to be. Clearly, this was not, the pressure has not been alleviated on this in the post-FOMC period. So it'll be really interesting to see whether or not small caps lead the way and break to new lows and really start to signal that something more ominous is underway.
Yeah, Patrick, I'm in agreement. I mean, this morning as we speak, PACW is down, 37%, and WAL, Western Alliance Bancorp, is down about 14%, with the rumors that PacWest Bancorp is going to try and seek a sale. So, after the failure of First Republic, this could be the the next bank to fall perhaps, and that's going to cause a drag on the regional banks yet again, right? So, what you may want to look for in this kind of bloodbath of a market in terms of the regional banks is, maybe pick a few names that you think may survive, and the ones that get thrown out with the bathwater, so to speak, might be the ones to be bought.
Yeah. Well, let's move on page 8. I have the chart of the VIX, and we finally have volatility coming slowly back into the market. We're not yet above the 20 handle, but certainly off of those very low depressed levels of volatility that we were at last week. What are you watching here on the VIX?
Yeah, I'm watching for that key area of 20 or so on the VIX. If we get above 20, I think we make a push toward 25. That would probably coincide with some news, like another bank failure perhaps. But again, right now we're expecting movements intraday of about 1.25% roughly. And realized volatility has been actually lower than implied volatility thus far. So let's see what happens going forward. But again, volatility suppression seems to be occurring on the longer term options. We're not seeing as much activity on the 30-day average options, and we're seeing a lot more activity on the ZRDTEs, which I think is still suppressing volatility. So it's possible if we get below that 40-50 mark on SPX, we see a sharp push down to 4,000. If we break below that, then we flush even harder. But again, if we get back above where we are right now to that 4,100 area roughly, and kind of cascade up to 4,150 or so, volatility should remain suppressed. But again, I think it's going to have a lot to do with both the regional banks as well as Apple's earning report tonight.
All right, let's move on to the dollar index. Let's start with you, Eric. What's your thinking here on the dollar?
No real change from last week. We're smack dab in the middle of a consolidation zone, and so there's no real trade signal here until we get a daily close below 100. So far, no sign of that happening.
Yeah, on page 9, I have that dollar index, and you can see how it's trading right along those lows. The ECB just came out, and it did have the U.S. dollar react a little bit off of its low levels. Whether the U.S. dollar holds this support line or not is going to be critical, because a dollar breakdown that starts, let's say, a move under 100 on the Dixie would spur a euro above 112 and certainly add fuel to something like the gold chart we're about to talk about, which could use that as a tailwind for a huge breakout. Watching what the dollar does here next is going to be critical.
All right, guys. Now moving on to gold, we have the gold futures chart on page 10. What are you guys thinking here as we push toward all-time highs?
I am surprised and impressed by the resiliency the market has shown in holding round number support at 2,000. Each time we dip down intraday to 1985, I was thinking to myself, okay, here we go. We're starting a correction down to 1,900 or so. And maybe I'll get a chance to buy some more gold on the cheap down there. Well, then whammo, I turn around and the market's back over 2,000. And now, as I'm recording before the open on Thursday, gold spiked all the way up at the 6 p.m. futures open on Wednesday and technically hit a new all-time high, although it only lasted a few seconds. It hit 2085. I won't be surprised if we're already at new all-time highs above 2085 by the time our listeners hear this podcast. Certainly it seems like the market is making an attempt at that Wednesday night. So check your own quotes, see where we stand, but as of Wednesday evening, an attempt was being made on the all-time highs. I thought it was going to take all summer before this breakout happened to new all-time highs. And of course, there's still plenty of room for this to fail here and reverse lower. So, it hasn't happened yet. But if we get an honest-to-good breakout, let's say well above 2,100 in the next week or so, that would be super bullish long-term. It would say that the market was able to slice through this major resistance of a new all-time high without much resistance whatsoever. It only took just a few weeks in order to get through it. So let's see what happens, though. It hasn't happened yet, and we're lining up a lot of dominoes here. So let's see what next week brings.
Yeah, interesting that gold did make that punch for a direct test of the March 2022 highs, and teasing everyone with the idea of whether or not gold is going to break to an all-time new high. I mean, this trend is very distinctly bullish. Higher highs, higher lows, every dip is being bought. But really, the big tailwind, in my mind, has been the relative weakness of the U.S. dollar. And so, like I was saying earlier, here, I think the U.S. dollar is going to play a really important role in determining whether the gold is going to make the breakout now. I mean, I think certainly when we look out a year or two, I feel pretty comfortable leaning into the idea that gold will be at all-time highs and running. But whether it does this move here in May and June of this year, I think is going to be all dependent on what the reactions are here in the currency markets. Major overhead resistance level, major highs. We're going to find out very quickly whether gold is able to make that big move. Nonetheless, I wanted to just wrap things up with a quick look at the uranium futures chart. And what's interesting is that uranium has been incredibly quiet for almost an entire year, just bouncing around between 48 to 53 on the U308 contract. And we finally are getting a breakout out of that trade range. Now, one day doesn't make a new trend, but it'll be really interesting to see whether uranium is starting to move. And it's interesting that it's happening because we see so much broad weakness in the commodity space, and it seems like uranium might be marching to the beat of its own drum. It'll be interesting to see whether this breakout actually sticks.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as a link to the chart book we just discussed here in the postgame, and a number of links to articles that we found really interesting. So you'll find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @EricSTownsend, that is Eric spelled with a K, and follow Patrick @PatrickSeresna. On behalf of Eric Townsend, Patrick Seresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Seresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.